QL Resources Company profile. So QL Resources Berhad is one of Malaysia's leading agro-food companies with its headquarters in Shah Alam and operates across Malaysia, Indonesia and also Vietnam. The company founded by Dr. Chia Song Kun and his family has grown into a big regional player involved in business ranging from livestock and marine products to the palm oil and also retail. QL is very well known for its firm commitment towards sustainability, assurance of food safety, and halal standard, thereby gaining a stronghold on customer loyalty with an employee base of thousands and diversified business portfolio. QL Resources continues its expansion based on reliable foods production, innovation technology, and also long-term responsible growth. So for the SWOT analysis for QL resources, we got strength, weakness, opportunity, and threats. For QL resources strengths, we got diverse business, reduced risk, and steady growth. Number two, we got leading fish meal producer in Southeast Asia. Number three, we got strong brand in Malaysia, Vietnam, and also Indonesia. Number four, we got focus on sustainability such as biomass, water, and also solar panel. And number five, we got halal and international certification. We move on to weaknesses. QL resources, first weaknesses is they got many businesses equal to complex operation. After that, we got profit affected by raw material prices. After that, number three, we got palm oil face strict environmental rules. Number four, we got high dependence on exports. Number five, we got fast growth equals to management challenge. We will jump to the opportunities. The first opportunities for QL resources is high demand for eggs and seafood in Asia. Number two, we got growing retail chance with Family Mart. Number three, we got popularity of green and eco-friendly technology. Number four, we got expand seafood export internationally. Number five, we got supply chain improvement equal to cost saving. And the last one, we got threats. The first threat is stricter environmental rules for palm oil. Number two, we got rising local agro-food competitors. Number three, we got raw material and fuel price volatilization, volatilities. Number four, we got currency fluctuation in Indonesia and Vietnam. And number five, we got climate change affects fish and plantations. So I will explain about business activities in QL resources. The first one is consumer foods. QL makes nutritious and convenience food products for both home kitchen and also restaurant, including popular items like shrimp, fish ball, and variety of snacks for all ages. Number two, we got marine product manufacturing. The business covers the full value chain from deep-sea fishing and aquaculture farming to processing raw materials into surimi, seafood, and also fish meal. The third one, we got integrated livestock farming. QL operates comprehensive livestock farmings across Malaysia, Indonesia, and also Vietnam, managing all the key stages of animal production efficiency. After that, we got palm oil and environmental technology. QL managed sustainability, palm oil, plantation, and also mining in Malaysia and Indonesia, following strict environmental standards under the ISPO system. After that, we got retail family marts. Through Family Marts, QL provides ready-to-eat meal and convenience food directly from consumer, creating a strong retail presence and enhancing everyday convenience. QL resources analysis based on my calculation. So based on my calculation, QL stock price history from 1st January until 31st December 2024, the expected return is slightly negative at negative 0.00086, indicating a very small potential loss over the year. The variance of 0.0453 shows moderate fluctuation in returns, and the standard deviation of 0.213 0.2212811,306 reflects relatively high risk compared to the expected returns. The coefficients of variation is extremely high and negative, uh, negative to 246.0.7085, suggesting that the stock's returns were very unstable relative to its average returns, making it a highly risk investment over the year.
Okay, Assalamualaikum and good morning. So my name is MEGAT ADHAM, Ismail, and I'm gonna talk about the company profile, which is SAMDABI. Okay, so first of all, the name of the company is I'm taking a SAMDABI Berhad, which we started as SAM following a 2024 rebrand. And the headquarters for SAMDABI is in Malaysia, which we call as a corporate site, investor materials as shown in Kuala Lumpur, and also Petaling Jaya offices. So the nature of Samdabi, it is a Malaysian multinational industrial conglomerate, or yeah, what we call as investment holding company, that after earlier demergers, they now focus on automotive, industrial equipment, manufacturing and engineering, aerospace, and also related services. So I'm gonna brief about the history. So basically, Sam Darby name it dates back over a century. So the modern group they emerged through mergers and later become a major demerger that separated the plantation and property arms into their own listed companies, which is the Sam Darby Plantation and Sam Darby Property in 2017. Leaving Sam Darby Berhad to evolve into a focused industrial, motors, and related services group. So in late 2024, the group refreshed its brand to SIME to reflect a sharper strategic focus on automotive and also industrial equipment. For the leadership and skill, the group CEO is Jeffrey Salim Davidson. Uh, it The employee count and revenue figures vary year to year, which is publicly reported figures and financial that are available in the group latest annual report. So for the moving on to business activities. Okay, so now moving on to the business activities. For SAMW, we have four, which is the motors, industrial and equipment, logistics, supply chain and services, and the last one is the investment and others. Okay, so for the motors, which is the automotive distribution and after sale, for this one, they have a multiple automobile brands across Malaysia, meaning selective regional markets only. So including the dealership network, parts and services operations, and also fleet solution. Basically, this is a major revenue for the cash and generator for the group. So for the second one, which is the industrial and equipment, which is elaborated as manufacturing, equipment, engineering, and also aerospace. This part they supply and service for the industrial machinery and equipment, which we can conclude as the construction, mining, and also material handling, manufacturing, and also engineering services. Plus with the aerospace related activities such as MRO, component supply, where it is applicable. So for the SAM position itself as a partner to industrial customer across the Asia Pacific region. Okay, so for the logistic supply chain and also services that conclude the logistic distribution, warehousing, and also other value added service. These all are tied to the motors and industrial segment. Basically, the activities there improve integrated service capability to the OEM and also business customers. So for the investment and others, which is the retail investment, strategic stakes, and also non-core business, basically all of these are property interests that weren't spun off, like insurance, financial service, and also in some areas. These are all handled under other or the investment holding functions in investor material. Okay, so moving on to the SWOT analysis. Okay, so now for SWOT analysis, which is we will start with the first one, which is the strength. Okay, so for the first strength is the strong brand recognition and also legacy sale. So basically, why does it matter? Sam Dhabi is known as a long-established Malaysian name with regional recognition, which help in their dealer negotiation, OEM partnership, and also government or large customer relationship. Basically, the brand longevity supports trust in B2B and also B2C dealings. So for the implication of this rank, it leveraged the brands to expand adjacent services, meaning like digital after sales and also fleet telematics, and to secure preferential OEM relationships or public-private partnership. So for the second one, which is the focus portfolio with market leading positions in key segment, meaning the motor and also industrial equipment. So why does it matter? After the demerger, SIM can concentrate investment and management attention on core, making higher margin in operational areas, focusing on also focusing often on improving their operational agility and also capital allocation. So their action is when they continue to prioritize aftermarket recurring revenues and service contracts to help smooth cyclicality of vehicle sales and also equipment of capex cycles, or we call it as a CAPEX cycles. So for the third one is the extensive distribution and after sale network. Why does it matter? Okay, so when both delay and service footprints create a recurring revenue opportunities like parts, service, and warranties, they often leads to higher customer retention. So basically, this is durable competitive advantage in automotive. So some W action is they invest in digital customer experience and predictive maintenance platform, so that they can increase their wallet share per vehicle or equipment. So for the last one, for strength is healthy capital position relative to scale. So why does it matter? Basically, public feeling and commentary show that the group maintains cash balance and also reasonable gearing, providing headroom for M&A and strategic investment. So some W's action is they use their balance sheets to pursue targeted acquisition in EV, electronic vehicle, or aftermarket tech, which is regional expansion or industrial automation capabilities. So moving on to the second SWOT analysis, which is the weakness. So for the first one is the residual brand and stakeholder confusion from the 2017 e-merger, meaning multiple entities shared by the same Dhabi name. So to present this, market or analysis confusion can dilute messaging and complicate investor comparability, especially when plantation or property news shows up under the same brand. Basically, this can affect investors' relation and also public perception. So what some Dhabi's action is they have a clear, consistent corporate communication which emphasizes group new identity, which is the sun, motors, and industrial, while providing simple segmentation in investor materials. So for the second one, which is dependence on cyclical sector, which is the vehicle sales and also heavy equipment. Vehicle and industrial equipment, the demand swings with the economic cycle, the interest rate, and also consumer business confidence, leading to earnings via volatility. So what some WS actions are, they grow resilient revenue streams such as after sale, parts, fleets, management, and also leasing, and the diversity of geographically to reduce local macro risk. So for the third one, which is the complexity of operating across many product lines and market transition, operating across many product lines and market. So basically, this one is the multi-segment operation that increase management complexity and can dilute focus if not tightly governed. Historically, conglomerates can face coordination and capital allocation challenges. So what Samdavi does is they strengthen their portfolio management, they adopt their clear KPIs per segment, and also consider divestment of truly non-core assets. Okay, so for the opportunities, which is the transition to electrification and new mobility. Okay, so for this one, we can conclude it as a electric vehicle, the fleets, and also charging infrastructure. Basically, when automotive markets are rapidly moving towards EV, for distributors and after-sale network, this is both a threat and a large opportunity for SAMW in making new parts, ecosystems, battery services, and EV servicing center. Symes dealers and also service in footprint positions to be a regional EV service leader. So what SAMW does is they partner with OEMs for exclusive EV distribution rights, roll out EV train service center, and also explore battery as a service and charging solution. So for industrial equipment demand and also green and automation project. So for this one, regional infrastructure, manufacturing automation, and renewable energy enable industrial parks are growing. So some industrial equipment and engineering capabilities can capture the aftermarket, servicing, and also project execution opportunities, which is related to the sisters company that are developing green parks and solar projects, signaling broader market momentum in Malaysia for green projects. So what some W does is they build project delivery teams for great industrial parks and also renewable energy equipment supply, which offer integrated equipment plus service plus financing solution. So for the aftermarket digital services and telematics, why does it matter? So basically, digitization of vehicle and equipment fleets creates high margin recurring revenue lines, where remote diagnostics, predictive maintenance, subscription services are included. So basically, some W they can monetize their existing installed base. What some W does is they invest in telematics or IoT platforms and strategic partnership with software providers as a pilot on captive fleets and then for scale. For the last one, which is the threat, the first one is the macroeconomics and demand shock, which says as a rates, recession, and also supply chain constraint. So new vehicle sales are sensitive to credit and economic health as equipment sales for CAPX dependent, where global or regional downturns can depress orders and push customers to delay purchases. So for some W, they mitigate in emphasizing flexible financing, strengthen used vehicle marketing, and also expand their service contracts to preserve, preserve cash flow in downturns. So for the second one, which is the competitive pressure from other regional distributor, digital first entrants and also OEM direct models, they may sell direct or new entrants could undercut traditional dealer margins. In maintaining exclusivity and adding value is also crucial. So some W mitigate by forging deeper OEM partnership, provide value-added bundle services like warranty, connectivity, plus and also financing, which improve customers' experience digitally. For the third one, which is the regulatory and policy risk, can conclude as trade, tariff, and environmental standards. So why does it matter? Automotive and industrial sector face evolving emission standards, trade policies, and also import-export rules, which can affect product mix and profitability. So their mitigation is proactive compliance teams, which include scenario planning and also flexible supply chain design. For the reputation and ESG risk, which is like group and similarly named sister companies, the Sun brand because the Sun brand they sits across companies like plantation, property, and also industrial. ESG issues is especially in plantation, which is the labor and land use, as it can create spillover reputation effects, and even for the industrial or motor focus time. So the news coverage of plantation labor or land disputes can cause stakeholder scrutiny uh, across the brand family. So some Dabi mitigate this threat by maintaining clear separation in reporting and communication, adopting strong ESG disclosure, and also independent verification for operation within SAM's permit, or what we call as permit. Okay, so moving on to the analysis based on calculation. So the expected return. So to begin with, the expected return or which is the average daily return, is found to be approximately to 0.00015. which can be translated as around 0.0 and 15% per day. Although these figures appear small, it indicates that the stock is generated a slightly positive daily return over the trend measured time frame, suggesting that SIMW share is a share price exhibited a mild upward trend, reflecting a generally stable market confidence and a lack of a drastic downward pressure during the period. Okay, so for the variance, which recorded at 0.001708, provide insight into the dispersion of a stock daily return. Variance of this magnitude suggests that while some W stocks did experience fluctuations, these movements were not extreme or unusually erratic. This is what we call as a consistent that is typically expected from an established, diversified industrial conglomerate such as SIMW, which they tends to experience moderately predictable performance pattern. So for the standard deviation that is calculated at 0.04132 or 4.13%, is a particularly important measure because it represents as the stock overall volatility, as they are nearly 6%, as they are nearly 4% a day. Basically, in the practical investment term, this level of volatility is considered moderate. So some W is not as volatile as high growth technology firms, but it is slightly more volatile than highly defensive sectors such as utilities, suggesting that the stock carries a moderate risk, making it suitable for investors who are comfortable with some degree of day-to-day price movement, but still prefer a relatively stable company with a strong industrial foundation. So overall, with the CV 265.23209999, the combined result shows that Sun W stock exhibits a balanced characteristic, a mild positive return paired with moderate and also manageable volatility. There are no indications of extreme outliners or abnormal price shock within the dataset, supporting observation that the stock performed consistently throughout the period studied. So for investors, this profile position SAMW as a reasonable option for medium risk investment strategies, especially for those that seeks exposure to stable, diversified Malaysian industrial players. In conclusion, the statistical evidence suggests that some W share maintains a healthy balance between risk and return, making them a dependable component within a diversified investment portfolio. That's all for me. I'm going to pass it to the next presenter.
Assalamualaikum, my name is Muhammad LUTFI. So I will be presenting about Mr. DIY Company, which is one of Malaysian largest company home improvement retailers. Mr. DIY was founded in 2005 by Tan Yuhil, and the company is headquartered in Seri Kembangan, Selangor. It is also a public listed company on Bursa Malaysia, which show its financial stability and strong corporate reputations. The brand is well known for its slogan, which is always low prices, and is currently offer more than 17,000 different products. This includes household items, hardware, electrical appliances, stationeries, leather goods, and toy, and so many. And over the years, Mr. DIY has expanded its retail concept into several formats such as Mr. DIY Expresses, Mr. Dollars, Mr. Toy, and the megastore version called Mr. DIY Plus. With its wide store network and strong brand identity, the company continues to attract customers from all income levels across the country. For the business activity, Mr. DIY operates mainly in the retail and consumer goods sectors. Firstly, the company runs a large network of physical stores across Malaysia. This outlet uses a simple service layout to make the shopping experience fast, convenient, and family-friendly. Secondly, Mr. DIY has invested in digitalizations e-commerce. They operate an online shopping platform that support delivery and a click and collect services to improve efficiency. The company uses automated and robotic warehouse system to handle inventory and logistics. Mr. DIY also has several diversified brands such as Mr. Dollars and Mr. Toy, which allow them to reach different customer groups. On top of that, the company has expanded internationally to countries like Thailand, Indonesia, the Philippines, and Turkey, Spain, and South Africa. Last, Mr. DI focused on sustainability and the human capital development. They take initiative to reduce plastic usage, promote eco-friendly products, and provide continued training for their employees. Next, let's talk about SWOT analysis for Mr. DIY. In terms of strengths, Mr. DIY has a strong brand recognition, a large of storage, affordable pricing, and a very wide range of products. The company also benefits from an efficient supply chain system and diversified retail concept. But however, it does face several weaknesses. Some customers perceive the product quality as low due to the affordable pricing. The company also works with thin profit margins, manage complex inventory, and compete heavily with e-commerce platforms. For opportunity, Mr. DIY has the potential to grow further internationally, strengthen digital platform, and improve partnership with global suppliers. There is also rising demand for eco-friendly products and greater use of technology such as AI for inventory forecasting. Finally, the company faces threats such as intense competition from other retailers, rising operation costs, currency fluctuations, changing consumer trend, and possible regulation changes. Overall, Mr. DIY remains a strong competitive player in the Malaysian retail industry. Now let's talk about analysis based on calculation for Mr. DIY. First, the expected return came out to a negative value which is 0.0008 or which is negative 0.08%. This is our average daily return a negative is a clear red flag. It tells us that over the entire analysis year, the stock average daily performance result in a slightly loss. In short, the upside down on goods rate was not enough to cover the downside on bad days. The second, which is standard deviations. Standard deviation, which measures the stock volatility or risk. Our calculation, which my calculation, value is quite high, which is at 0.98546 or 19.5 19.85%. This signals that Mr. Dawa stock experienced significant price swing. For an investor, high standard deviation means high uncertainty. The stock is highly volatile and the actual returns are far from stable. The third one, which is variance, the output is 0.3942. This mainly the statistical input is high meant to confirm that there was a massive spread in Mr. DIY. A daily rating data reinforce our calculation that the stock is highly risky and unpredictable. And the last one, finally, the most complementary is the configuration of variation, which is CV. This number measures the risk taken per unit of return achieved, making the ultimate test of efficiency. And the number that we got, which is that I got is negative 247.139. This massive absolute value computer stock Edryn or kind of efficiency that we can conclude that for analysis pyramids they are provided based on no positive return and compensate investor for massive uh, big risky they had the investor to face. This definition of a poor investment from a risk adjustment perspective for Mr. DIY. That's all from me. Thank you.
All right, thank you, Lutfi, for the wonderful explanation. So next, I will present on the company of Sunway Berhad. So, Sunway Berhad is founded in 1974 by Tan Sri Dr. Jeffrey Chia, and today it operates in more than 50 locations worldwide. So, Sunway core businesses are mainly in property development and also construction. But what makes the company truly unique in its vertically integrated system is that it covers 12 major business divisions. These include property investment, retail, hospitality, healthcare, and also education, manufacturing, trading, and also even leisure attractions. So one of the most important things that people know about Sunway is its build, own, operate, boo model or boo. So the model means that Sunway doesn't just build properties, but they also open and own the malls, hospitals, and also hotels, even the university beside the mall. So this allows Sunway to generate a long-term recruiting income while creating a fully integrated townships like Sunway City Kuala Lumpur, and also transform from a former mining land. So overall, Sunway's business model emphasizes sustainability, synergy, and also long-term value creation. All right, and now I will explain about Sunway's business activities. As you can see here, there are three, which is property development, construction, and also strategic asset operations. So Sunway operates a very wide range of businesses. So as we know, there is property development. The company is very known for as a master community developer, building large integrated township with residential, commercial, and also recreational components. So for number two is construction. Although the Sunway Construction Group, Sunway is a construction group, so they handle major local and international projects. This makes them unique as they have a strong internal order book from Sunway Property, which gives them a steady pipeline of projects. Sunway also manages the strategic assets through the BOO model. So this include retail malls like Sunway Pyramid, hospitals under Sunway Medical Center, hospitality and such as Sunway Hotels and Resorts, leisure attractions like Sunway Lagoon, education institutions like Sunway University. So these businesses create a complete ecosystem that supports one another. Finally, Sunway has additional activities in trading, manufacturing, and also quarrying, which support their construction and also development activities. In summary, Sunway businesses activities are very interconnected, which allows them for easy development, construct, own, and also continuously generate sustainable income across their entire value chain. So for SWOT analysis for Sunway Berhad, we will begin with the strengths. So Sunway biggest strength is it diversification, which with 12 business divisions, the company is naturally protected from downturns in any single sector. So their bull model provides strong recurring income from malls, hospitals, and also universities. Sunway also has a strong ESG reputation, being aligned with the UN Sustainable Development Goals and also listed on the FTSE for Good Index. So another major strength for Sunway is that their international construction overbook. This ensures consistent projects for their constructions. So moving on to their weaknesses, their company have large conglomerate complexity that can lead to complex operations and also slower decision making. So also many of their assets, especially the property investments and healthcare, they are heavily concentrated in the Kelang Valley, which increases geographical risk. However, regarding the weaknesses, Sunway also have strong opportunities, especially in healthcare and education, which is fast-growing and recession-resistant sectors. So Sunway is very well positioned to benefit from the government's infrastructure projects, such as the upcoming MRT3. Also, Sunway can also expand further into Asian markets for construction and also property development. So for the company's threats is that the company main threats is includes the economic downturns which can impact the property sales and also the mall performance. So they also face strong competition from one another, from other major developers and also contractors. So, lastly, their rising raw materials costs and regulatory changes can affect their construction and also manufacturing segments. Okay, moving on from what we get from calculating Sunway's analysis. So, we calculated the four key metrics, which is expected return, standard deviation, variance, and also coefficient of variations. So first we will look at the expected return, which is 0.001524, which is around 0.15% per day. So this means that Sunway's stock basically on average has had a slightly positive upward trend over the period. So looking for number two, which is the standard deviation, the value is 0.019702, which is 1.97% per day. So for the volatility shows moderate, as Sunway stocks is not too risky, but it still has a daily price movement. So moving forward, for the value of variance is 0.000388. This shows us the support of observation that daily returns are not widely dispersed. So number four is the coefficient of variation. So this is one of the most important metric. So the value here, as we can see, is 12.927. So a higher CV basically means that the stock carries more risk relative to the return earned. So even though that Sunway shows positive returns, the level of risk is still considered high compared to the reward. Basically, in simple terms, Sunway performs positively, but the risk-adjusted efficiency is low. So this means that investors should balance it with other assets for better diversification.